Hi, everybody. Good evening. Welcome to another session. Hi, good evening, everybody. Welcome to another session of Endowus webinars. Really excited today to have our dear friends from Franklin Templeton, John and Matt. They've flown in all the way from Silicon Valley in California to join us here today in the Singapore office of Endowus. We're really excited. Maybe we can get the slides going so that we're going to talk about technology investing, AI, and especially ChatGPT, which is the rage. Just a quick couple of disclaimers from Endowus, and also some disclaimers from Franklin Templeton that we need to show you guys. And then we're going to have a very quick introduction about Endowus for those of you who are joining us for the first time. And this is actually our first webinar where we are welcoming our Endowus clients from Hong Kong as well. So welcome to all of you in Hong Kong, as well as everybody here in Singapore. Endowus was built to empower individuals and families to thrive and achieve their financial goals through quality advice and access delivered at low fair cost. So they can invest better to live better. As you know, we're backed by some of the biggest names in financial service and venture investing, including the biggest private bank in the world, UBS, their first fintech investment in Asia Pacific, EDBI, the Economic Development Board, global investment arm here in Singapore, Prosus, which is the largest shareholder of Tencent, and Delivery Hero, and et cetera, et cetera. And some of the biggest venture investors like Lightspeed Global Investors. But Endowus is a company that's still very much owned by the employees, and we are hard at work trying to help you invest better so that you can live better as well. We're the only digital wealth platform to provide a wealth advisory service for both your private wealth and public pension. It's a fee-only wealth platform. We're in Hong Kong and Singapore, the only truly independent digital wealth platform. So we are conflict-free. We always do what's in the best interest of the client as a fiduciary. We have innovated the 100% cashback of any commissions or trailer fees, as they're called, that are paid to us by the fund manager. So we can always choose the best products and offer it at the lowest cost for individual investors so that they're empowered to make better choices that will lead to better outcomes and better returns. Now, Franklin Templeton obviously is one of our very close partners who've been with us for a long time. And, we do a lot of content through webinars like this, but also a lot of write-ups. We partner with fund managers or influencers and wonderful content creators to do this together. And we're really excited that our content platform is really growing and allowing empowerment to individuals as well. And finally, just wanted to share with you the Slido link so you guys can go in. And I noticed that we actually have a lot of questions already, but the special feature of Slido is that obviously you can upvote your questions. So please go and take a look if you like some of the questions and upvote it, and we'll take the questions from the top so that the most popular questions will be answered first. And with that, I want to jump in. I think that our guest speakers can warm up by maybe introducing yourselves, John and Matt.
I'll start. My name is Jonathan Curtis. I've been in the technology sector, both as an engineer and an investor for more than 30 years now. I've been at Franklin Templeton for about 15 years. And at Franklin, I wear a number of hats. I'm the lead manager for the Franklin Technology Fund. I am a research analyst. I also lead our technology team, and I'm the head of portfolio management in the Franklin Equity Group.
Hi, everyone. Matt Cioppa. I've been with Franklin Templeton for about 8 years now. And I've been in the industry for about 15. And like Jonathan, I started my career more on the technology side at a financial software company, and then pivoted pretty quickly to the investing side. And for my last 8 years at Franklin, I've been a technology investor focused on various areas in enterprise technology, then joined on as a co-manager for the Franklin Technology Fund at the end of 2020.
Wonderful. Welcome, John. Welcome, Matt, to Singapore and the Endowus office.
Thank you.
How long are you guys here for?
Just 2 days.
2 days, okay.
Lovely offices. Thank you for being so warm and inviting to us.
Okay, wonderful. Great to have you guys. Look, guys, I think, some of our investors may not be as familiar with Franklin Templeton. And I want to point out that Franklin Templeton is not only a good partner, but the technology fund in particular is a product that is on our Fund Smart platform. But also, I think it's the lowest cost available in Singapore on the Endowus platform, but also is part of our globally diversified technology portfolio. And John and Matt are the two key portfolio managers who run that strategy, among many other hats, as they just explained. But would love to hear a bit about Franklin Templeton. What is the company, and also, how you view investing in the technology sector as a global tech investor?
Sure. So first on Franklin. Franklin's been around for more than 75 years now. It's a multi-asset manager that manages $1.4 trillion of assets across fixed income, equities, and alternative investments. Matt and I are a member of a part of Franklin called the Franklin Equity Group. Our part of the organization manages about $120 billion of assets, and we are located in the innovation center of the world, right in the middle of Silicon Valley. So it's a great place to be focused on technology, working out of Silicon Valley. So Matt and I live and work there and do a lot of interactions in the community.
Next slide.
So I'll spend just a little bit of time talking about some of our expertise and where we're spending our time as investors. So if you remember anything out of this discussion, I want you to remember these 5 key points. First off, we believe there's a massive opportunity in something we call digital transformation. Our thesis is that companies and governments are still in the early days of learning how to use software and data to better understand their customers and their business processes, and then technology to radically transform how their industries operate. Underneath that big opportunity of digital transformation, we've identified 10 key sub-themes across artificial intelligence, machine learning, cybersecurity, digital media transformation, digital customer engagement, cloud computing, cybersecurity. So our strategy and our expertise is really built around digital transformation, and then identifying the best ideas across each one of those core sub-themes. If you could just go back one slide, please.
Yeah.
As investors, we tend to think very long term. Our strategy has been around for more than 20 years, and so very long-term orientation. Almost our entire team is located in Silicon Valley. That is certainly, we understand that tremendous innovation happens all over the globe. Certainly, we're seeing a really exciting innovation happening even in places like Singapore with firms like Endowus. But being in Silicon Valley, which is clearly the home of many of the world's most influential technology companies, like Apple, like an NVIDIA, like a Tesla, like a Google, is a tremendous place to start our work from. We have deep relationships at firms like that, but also deep relationships in companies that are recently public and private companies, and certainly the venture capital community that finances them. And still, more than half the world's venture capital is deployed in Silicon Valley. So working there is a really compelling differentiator for us.
Yeah. Actually, that's really important, John, because I think one of the reasons why we like the Franklin Technology Fund and have it in our portfolio is the fact that it's very rare for a public market investor to have some exposure to private markets. And I think that's a real differentiator and a competitive advantage for the fund.
And a critical part of our work, being able to do work not only in the publics, but also combine that with our work on the private companies.
That gives you the really complete picture of the competitive landscape, look at opportunities that are emerging in the spaces, right?
Yeah. And our strategy and the processes we've been using have been around. We've been around for more than 20 years. Yeah. So just a lot of deep expertise and honing of our processes to get to where we are.
Next page. Yeah.
So then these are the 10 themes that we are focused on across our strategy. Artificial intelligence, machine learning, I think is an enormous opportunity. And of these 10 themes, probably one that is the least understood, quite frankly. Certainly, we've all been dazzled by what we've seen with some of these generative AI models across text creation and media creation, but I don't think investors appreciate how profound these models will be once they are integrated into the knowledge worker tools that we use, that many hundreds of millions of knowledge workers, media creators, and software developers use every day. And this isn't something that's coming many years out. Within the next year, I think every one of us will have access to these tools in our knowledge worker tools. So we think a profound productivity surge is coming. And that's going to put tremendous pressure and create a lot of growth in and around artificial intelligence. We're very excited about that. The other opportunity on this slide that I think is misunderstood right now is cloud computing. We think that opportunity is at least $2 trillion in size. We think under 20% penetrated. And while it's going through a bit of an optimization phase right now in this post-COVID era, we think that there is a very long runway for growth. And one of the new workloads that is going to emerge on the cloud, of course, is going to be generative AI. So of the themes where we are focused, AI, machine learning, and cloud computing, we think offer significant alpha generation opportunities. Next slide, please. And this slide is really meant to help investors understand where we are in this digital transformation journey. One key metric on here is the 10.3%. That's our estimate of how penetrated digital techniques and innovation techniques around digital transformation are in just the US economy. So there is a long runway to growth to get to a fully digital world. And the rest of the world is even below that level. So there's a lot of growth ahead around this opportunity, we believe, in digital transformation. Next slide, please.
Wonderful. Thank you, John. I mean, if we turn to the technology sector and its performance, as an investor, and maybe Matt, you can touch on this. We had a terrible year last year after a stellar decade of outperformance of the technology sector. And we've seen some rebound, but it's been volatile. So how do you see markets faring from a broad technology sector perspective? And maybe you can go through some of what's actually happened and how you look at this landscape right now.
Yeah, sure. So we still have investors reaching out to us all the time who have suffered a little bit of heartburn going through last year. And they're curious our perspective on are the waters safe now? Are things changing? Is the tide starting to turn a little bit for tech? And so I'll spend just a couple of minutes going through our perspective on this. First, I think it's helpful to look at 2022 and some of the drivers of that underperformance for tech. And so in this chart here on the slide, you can see sector level performance across the 11 sectors of the S&P 500 for an isolated period of November of 2021, which was the peak in the NASDAQ, to October of 22, which was the peak in the US 10-year Treasury yield. And for this 11-month or so period, really the only thing that mattered that impacted tech performance was rising inflation and the corresponding rising increase in interest rates. So we saw the 10-year yield spike up, and we saw, as you can see on this chart here, underperformance for tech and communication services. And this makes sense to us, right? In tech, you've got longer duration, growth-oriented assets, which are generally disproportionately impacted by rising rates. What also happened last year, really starting in the middle of the year, was we started to see a deceleration in growth across various tech sectors. And this was a direct result of a tremendous increase in consumption of tech, both by consumers and by enterprises during COVID. And the chart on this slide here is meant to convey exactly that. This chart shows the aggregate annual revenue increases of the largest technology companies in the world on an annual basis. And you can see, looking at 2021 post-COVID relative to pre-COVID, we saw almost a 3 times increase in that aggregate annual revenue from tech. This is a tech-specific phenomenon. And I think we know by now the story. Consumer behavior changed dramatically, right? Folks were going more online, they were shopping there, they were engaging with digital advertising, buying more phones, buying more computers, et cetera. But that's only part of the story. We also saw enterprises, really in businesses of all sizes, forced to adopt and modernize new technology so that they can meet their customers where they were and engage with them digitally online. And so that brought in a lot of increase in cloud computing and modernizing data centers, modernizing applications, adopting software as a service, et cetera. So that started to go on. We started to see the normalization of that demand in 2022, and we're seeing it in 2023 as well, leading to deceleration and growth for the sector over the last 3-4 quarters now. Next slide, please. And so how is the tech sector responding? We have seen a concerted effort by technology businesses, both small and large, right-size their cost base and really try to become more efficient in the face of slowing or normalizing demand and rising cost of capital. And this chart here in the slide shows the number of layoffs, right? Number of employees laid off in the technology sector going back over the last 15 months or so on a monthly basis. And you can see a real acceleration in the back half of 2022 and a peak around January of 2023 this year. Importantly, if you look at the last few months, that trend has started to reverse a little bit. I think it's a signal that we are starting to get to a point at which technology businesses have adjusted appropriately for the new demand environment and the new cost of capital environment. But this, again, to us is evidence that the technology sector is already in its recession and is responding accordingly. Next slide, please. So let's pull forward this discussion from October of last year, which was the peak of the US 10-year Treasury yield, to today. And we're looking at that same relative sector performance chart. So IT and comm services has gone from the worst performing sectors in the market to the best. And again, this is pretty well explained, right? We've seen signs of inflation easing, right? We've seen signs of stabilization in the rate hike cycle as a response. And so that headwind on multiples for the tech sector last year have started to subside. I think investors are also considering the fact that we're 3 to 4 quarters into this COVID digestion period and this negative estimate revision cycle for technology. So we think we're more than halfway through that period of negative estimate revisions and starting to get to a point where we can look for reacceleration again. And then finally, I would add, it again with the cost optimization, the layoffs we've seen, these businesses in technology are flexing their profitability. They're looking more profitable than ever, and I think investors appreciate that aspect of the sector. And then we'll talk about AI a lot, but certainly enthusiasm over AI has brought investor interest back to the space as well. So zoom out for a second. If we take that entire period from the NASDAQ peak in November of 21 to today, even with the recovery in tech in the last few months, these are sectors that have still had middling to underperformance over that period from late 21. Next slide, please.
I just noticed it's exactly in line with the market, though.
Yeah,
right.
Exactly.
So it's not a massive underperformer.
Not a massive underperformer anymore. Yeah. That's right. But not an outperformer either. Mm-hmm. And relative to that performance, we like to look at various measures of quality on a relative basis. And this chart shows the net cash position for all the sectors in the market. Tech and communication services are the only two sectors with a net cash position on their balance sheets. This gives them more flexibility to engage in accretive M&A or shareholder stock buybacks. And it also reduces the burden on a relative basis of increasing costs of capital because these businesses are generally well capitalized already. Next slide. Just one more look at relative quality. Tech and comm services are also two of the most profitable sectors in the market. And so we've got strong balance sheets, we've got strong profitability. And then finally, if you can just move to the next slide, we're not paying a tremendous amount for that quality and growth profile. So we look at valuation on a price to earnings to growth basis. And today, information technology is roughly middle of the pack relative to the market. Communication services is still looking inexpensive. So overall, we think this is a reasonable valuation and reasonable price to pay for that superior growth and quality profile of the tech sector.
So actually, a lot of our investors are very well versed in like factors and systematic investing, because Dimensional is a strong partner of ours, and we looked at some of the way you guys invest in technology. I think we can define it as being focused on quality, focused on growth, and I think can you say you're a contrarian or like more long term?
We're very
secular,
long. Yeah, good question. We're very long-term, bottom-up investors.
Yes.
When we look for quality, we want to find businesses that have very strong business models, led by strong managers, and ultimately good financial metrics or evidence of coming good financial metrics.
Right.
On growth, we're looking for very large markets and companies that can build multiple S-curves on top of one another across product and or geography, so they can deliver many years of growth. And then on valuation, while Matt showed the price to earnings to growth slide, we do our valuation work always on each company that we seek to own from a bottom-up perspective, using a multi-year discounted cash flow analysis.
Right.
And that allows us to see what we are underwriting, both across the top line compounding, but also the leverage in the business, and then bringing that back to the present with an appropriate cost of capital.
Right. Sounds good. And pure bottom-up investors, no macro kind of top-down.
Yeah.
Because the secular growth bottom-up is what really drives long-term.
That's right. Now, we are certainly aware of where we are in the macro environment right now. And certainly we know that we could potentially be at a pivot point with regards to rates. But we can talk about that a little bit.
Yeah. Okay, sounds good. And now we're going to move over to the most exciting topic. We sold the AI piece in our webinar advertisement as well. But AI has been talked about for so long, and maybe we can even argue that it hasn't really held up to scrutiny up to now. But ChatGPT has just completely changed the landscape. I think it's really even the average person in the street knows about it, are trying it. My kids certainly know about it. And Endowus as a company, as a technology company, we're embracing it. We're actually applying it in our client interactions and chatbots. We haven't launched it. We're experimenting and looking into it with multiple service providers, and then maybe in the future in investment advisory as well. So it's definitely something that is tangible. It's something that we're definitely looking into. But people forget that it's ChatGPT 4. People forget that it's a fourth version, and this is something that's been going on for a while. So we'd love to hear kind of the journey, maybe for those investors that are less familiar with AI and machine learning and this whole even generative AI, which is a slightly different area. Maybe the next slide we can start, maybe helping investors grasp what this is and how big the potential is.
Sure. Yeah, I can start us off here and touch on this. So you're absolutely right. I mean, it's AI has been talked about for a really long time. This is a quote we like from Sam Altman. He made this quote in 2021 in an essay that he wrote called Moore's Law for Everything. And I won't read the quote on the page, but this to us represents the long promise of AI. One that I think, like you said, a lot of folks believe has been under-delivered on. And so I think a lot of people are wondering, well, what's really changed now about AI? And this slide here, I think represents the step function change has occurred. Really, it started in the last in the last few years in 2017 with companies like Google and OpenAI creating an architecture that enabled not only the consumption of almost the entirety of the internet, which is pretty impressive or very impressive in and of itself, but also the ability for these AI models to converse with humans in a very natural way. And anybody who's played with ChatGPT knows it is a very different experience relative to talking to a Siri, say. And so in November of 22, with the launch of ChatGPT, we think that was the first real moment where everyone started to really get the power of this technology. And so a lot of us have seen this before, right? We know how popular it's become. ChatGPT grew to 100 million users in just 2 months. That's a fraction of the time it took some of the largest internet services in the world to reach that level of adoption. And so a lot of people are calling this the iPhone moment for AI, right? If you think about the iPhone, that was the form factor that really ushered in the mobility era. And in doing so, created literally hundreds of billions of dollars of value across app creators, digital media and content producers, created a boost to digital advertising, semiconductor suppliers. And we think,
and not to mention two multi-trillion-dollar companies in Apple and
yes,
Google.
of course,
Yeah.
And so we think that ChatGPT could be that moment for AI.
And before I get into these slides, I would just highlight that you said at Endowus you're doing a lot of building right now and experimenting with generative AI. You are in very good company. As we looked across this past earnings cycle, across all the companies that we invest in and companies we are studying, literally every single company we're talking about aggressive pivots they were making in their R&D roadmap to figure out what these generative AI technologies mean to their business and what they need to build and how it's going to change their business model. And I think, I mean, this reminds me back to that iPhone moment when technologists all saw what was possible with the iPhone. Within a couple of quarters, every company came up with a mobile strategy very, very quickly. This feels very, very similar. And because it drives such productivity gains, we believe it's going to be very, very big and adopted very broadly. But let me just get in some of the examples here. So Microsoft has really been acting almost like a startup in its own right, aggressively putting these models into large parts of its platform. And we're seeing other companies following along. Let's go back to the prior slide. So Microsoft, for instance, is big.
I think one of the problem is that people don't realize GitHub is actually owned by Microsoft.
My apologies.
Just like LinkedIn is another product and service that is owned by Microsoft, and now OpenAI, ChatGPT as well. So it's actually amazing how Microsoft has been so, ahead of the curve on all of this. But I'll let you continue with GitHub.
So Microsoft bought GitHub many years ago. GitHub is an open source code repository that has hundreds of millions of software developers sharing and collaborating on code in it. And hence it is a large and compounding data set of software. Microsoft and OpenAI has used that database to learn the structure of coding languages. And now they have introduced a tool that software developers are using to auto-generate code. And in many instances, I met recently with Satya Nadella of Microsoft, and he said that the average developer is generating more than 40% of their code using these large language models and the GitHub Copilot. And in the case of Java, more than 60% of the code is coming out of these tools. So tremendous productivity gains for software developers. We think that this is actually going to create an era of software acceleration because the number of software developers has always been constrained. Human productivity and desire for software has always been greater than the number of software developers. So this is really going to help. Next point, or next slide, please. Same thing for Office, but you could put up a slide also, the same thing for Google. There are many, many hundreds of millions of Office workers that use the Office Productivity Suite and many millions of users that use the Google Productivity Suite. In the space of the next few months, these models are going to be placed into those tools and made available for everybody across email, across word processing documents, across slide generation, across collaboration tools like Microsoft Teams. And it's going to allow knowledge workers to quickly summarize emails, write the first drafts of key reports, summarize meetings. It's going to drive a tremendous amount of productivity and ultimately serve as a force multiplier for knowledge workers and make them dramatically more productive and allow them to focus on higher value things. The same thing we're seeing in media creation. DALL-E and firms like Stability AI and Midjourney have created tools that allow creators and normal people like ourselves to, with text prompts, generate beautiful images. And we think that this is going to create a new era for media generation and create new demand for media tools like those provided by a firm like an Adobe, for instance. Next slide. And then this slide is a picture, actually, of a successful text prompted image that was created with one of these models. It was so good, it in fact won an art prize. It's a beautiful picture, but it was done through creative prompting on these text to image models. And I mean, it's incredible. So just a lot of exciting productivity gains lie ahead when these models are put into the media creation tools, the software development tools, and ultimately the office productivity tools that many hundreds of millions of people use every day. And this isn't coming 2 or 3 years from now. It's coming within months.
Yeah, it's actually interesting because, many of the things you've already mentioned are stuff that we're looking to, and you mentioned every company's really, that was the word, like aggressive pivot in their R&D strategy and their investments and everything. But, a lot of questions here in the Q&A as well. What do we actually invest in? Because, how do we interpret that macro, big picture view that AI is finally here, ChatGPT, and how it revolutionizes the way we work and our life, but what's going to actually be good investments for the future when it comes to AI?
First, let me make the case for active management.
Yes.
There is a lot of change going on in the technology sector, a lot of experimentation going on right now. Your business, many of the businesses we invest in are starting to experiment aggressively with these generative AI models. In many instances, these companies don't even know how they're going to use it yet, and they're not entirely certain what the business models are going to be. So it's critical in moments like this to have active managers digging in deep, talking with these companies, thinking about where real value creation is going to come.
Maybe if I can butt in there a little bit, because our top question is, why choose Franklin Templeton Technology Fund over QQQ or a NASDAQ or an index fund? And it goes to the fundamental question between active and passive investing. And in the technology sector, it is one of the sectors where long short investing actually could work. Another one that I am very familiar with actually is the automotive industry, where there's clear winners and losers. And oftentimes it's a zero-sum game, but the market itself is growing in technology. It's slightly different. But because there are guys who are going to use AI and they're going to succeed. And there are going to be guys who are going to be left behind because they haven't adopted AI, right? Is that the right way to look at it?
I think that's exactly right. There's some clear, obvious winners. The semiconductor companies like an NVIDIA and AMD, the semi-cap equipment companies that enable the building of those chips, the EDA providers that enable the building of those chips and the foundries. So clear winners in the semi space. Some of the cloud computing companies are going to do very well. And even some of the infrastructure management software companies that deal with data, we think are going to do very well. But figuring out the winners and losers after that is going to be very complex. And you're going to need a team, we believe, of experts digging through this, meeting with the companies, using the products, talking with the customers, and ultimately evaluating the business models of these companies to understand whether it's an opportunity or a threat to these companies. And so that's really the case for active management in a time of such dynamic change.
Yeah, absolutely. I think the other thing is that, a lot of investors go the other far extreme and say, hey, what's the one name that we can bet on and bet the farm on? And the answer is there isn't like one, and putting all our eggs in one basket could actually be a very risky bet because there's a whole supply chain, right? And there's going to be different players, and only time will tell who will actually be able to be the winners for the biggest pieces of the market. So I don't know, you have this slide, maybe you can talk through some of this and tell us where are the biggest addressable kind of markets, opportunities, what are the highest conviction kind of bets that you have, and why you should own this whole portfolio rather than just one out of this whole stack of ideas.
Matt, why don't I talk a little bit about the software companies, you do the semis,
Sure.
and then talk about the EDA providers.
Yeah, great.
So in the software side of things, we've already talked about Microsoft. Microsoft has all this real estate where they can start putting these models, and they plan to charge for them, and we think going to generate tremendous revenue. And we're not talking about small amounts of revenue. Tens of billions of dollars of revenue potential come off of this and just the products we can see today. So they're a clear winner. On the private side, a firm like Databricks has helped bring enterprise capabilities to a key piece of infrastructure software called Apache Spark. So we think that they're going to do well.
Shout out to the Databricks team and Snowflake, who are very close friends of ours.
Good. The team at Snowflake aggregates tons of data, and they're building in tools into their platform that allow data scientists to build models. The team at Confluent that deals with data streaming between systems, we think is going to do very well. The cloud computing companies, certainly first and foremost to Microsoft with OpenAI, but also Google or Alphabet. They have strong AI capabilities and language models in their own right. They run on their own proprietary semiconductor infrastructure, but also Oracle or an Amazon, we believe, are going to do well. And we think there's even opportunities for the software developers. There's a big debate in the software tooling ecosystem right now. Are the software developer jobs go away, or are there more software developer jobs that are created? We are on the side that there are more software developer jobs that are created as a result of this. Matt, why don't you talk a little bit about the semi?
Yeah, so I mean, look, we love the semiconductor category as a play on artificial intelligence. If there's one thing we know about this trend, is that it requires a ton of compute capacity. And there are some of the obvious players like an NVIDIA, which has been touted an AI winner, we think for good reason. GPUs are the building blocks for AI compute, and NVIDIA is a strong market leader in that category. I think it took 10,000 GPUs to build the supercomputer that OpenAI used to train GPT-3. We know we're in a supply shortage right now, and NVIDIA is not just providing GPUs for the makers of these models, but they're building a software ecosystem around themselves to allow developers to better make use of those GPUs, and also even get into specific verticalized foundation models in use cases in areas like healthcare, for instance, chemistry and the sciences. So there's a tremendous opportunity there, but it's not just an NVIDIA story. There are a lot of beneficiaries in semis. Lattice is a smaller and maybe lesser known company. They're building low powered FPGAs. Think of them as sort of custom programming chips that can be deployed at the edge, and for AI use cases and say a smart city use case or a smart home use case, having a low powered way to run inference on an AI model across devices across your home or a city. Someone like a Lattice can enable something like that. They're going to be a big player here. A lot of the networking chip providers, a company like Marvell, it's not on this slide, but also a beneficiary. AMD taking market share in servers on the CPU side, and also a powerful second supplier in GPUs. And given that we're in a shortage right now, they're in a good position. And then you extend it to the manufacturing ecosystem. So Taiwan Semiconductor is still the dominant player in leading edge chips. They are just going to continue to shine as more and more demand comes for leading edge semis. And they rely on the equipment makers to help them build these advanced chips. And so companies like ASML and KLA and Applied Materials are also going to do very well. And then I'll just jump over to networking hardware here. A company like Arista, they are doing the hard work of ensuring that data centers are built out with powerful and efficient networking architecture that allows cloud service providers and the makers of these models to maximize and optimize the use of the compute infrastructure within those data centers. So these are the picks and shovels category or players to invest behind to get exposure to the AI theme. So we like all of those. I'll mention one more category that's in the software bucket here, but electronic design automation companies, the businesses that make software that chip developers use to design chips. Tremendous impact they're making right now by also incorporating AI into their own tools to make the chip development process that much more efficient. So we see them as an interesting category as well.
Yeah. And maybe going back to that question about, selecting the winners, diversification within this, concentration versus diversification. I mean, it's a concentrated portfolio within the technology sector, but you don't want to own just one or two stocks, right? I mean, putting all your bets in one basket, because, there's a lot of questions about, what are the top AI companies to invest in? Which ones are going to be the real winners? But do we know? And, is it too soon? Or, how do you answer that question? Yeah.
We feel pretty good that these names are companies that are more prone to win than lose. Some of these companies in the semiconductor space, we have even greater confidence. And so we express that confidence by having larger positions. And then the companies where we are not as certain, we have smaller positions in. But across all of these names, we are actively doing research and trying to understand what are the characteristics of a winner and making certain that we are constantly checking in with the companies, their customers, their competitors to make certain that our framework is correct in identifying that.
Yeah, fantastic. There is an interesting question about, AI being used for investments, versus traditional managers. And I guess maybe too early, a lot of robo-advisors, especially in Asia, not so much in the US. In the US, the robo-advisors are very passive and strategic in their investment portfolio, like us. But a lot of robos in Asia actually became very active and said, hey, we have an algorithm that's going to beat the market, and they've failed miserably, especially last year when a lot of these active managed, robo kind of funds and platforms kind of blew up in their performance. And I honestly, there's a lot of emotions involved, greed and fear that AI maybe cannot. But do you think a day will come? Do you think where are we in that journey? Do you think?
Yeah, I certainly
personal views. Yeah,
I certainly believe that artificial intelligence will have a role in the investing process. I don't know if we'll be using large language models and media creation models to build portfolios, but I certainly believe that our analysts, Matt and I, as portfolio managers, will be using these tools as knowledge workers to more quickly understand companies and investment opportunities, to learn new spaces more quickly. I think our firm and your firm will end up using this technology to better serve our clients, to help get marketing material out to them, to help them understand how their portfolio is performing. So there's a lot of opportunities to use these tools to make the investment process more efficient and to make our operations more efficient. So that I feel very confident.
Right. So more like using the Microsoft language Copilot, kind of tools to help us become more efficient, maybe aiding tools, but not really something that's going to solve the problem. It's to the person who asked the question, obviously, we've looked at this in a major way. And if there is a solution, then, we would not have a market, first of all, because, and we would all be out of a job. But the reality is that a lot of these algorithms have just not stood up to the test of time. Some of the biggest, technology companies are investment firms like Renaissance Technology or Two Sigma or, systematic quant guys. Who have 100 PhDs and supercomputers, right, churning out a lot of data analysis on this, and yet they underperform in a year like last year. So those are things that suggest that it's still too early for investments to be taken over. But I think there is a lot of things that AI can do for us.
I think they will be tremendous co-pilots. The best investors are well-read. These models are well-read. They're creative. And they use technology to gain an edge and an advantage. And I think that's exactly how these tools will be used.
When I was in Morgan Stanley Investment Management, I used to tell every analyst, you got to read a lot. That's how you become better investors. And Warren Buffett and, the famous John Curtis is saying that too. So that's great. We're aligned. Maybe one other question that people have asked, and this is out of the blue, but how about metaverse? Because that's something that everybody was talking about cashing in on, and there were like investments that were made, but it's kind of like disappeared, and it's been overtaken by AI and ChatGPT. But is this a fad? And any views on metaverse since?
Yeah, so certainly there was a lot of attention around the metaverse when Facebook changed their name to Meta, and they were making very significant investments in the metaverse. They pulled back a little bit on that. I think a lot of the types of investments that Meta was making and are being made in and around the metaverse are highly relevant to the gaming sector, to entertainment. Maybe potentially a little bit in terms of productivity. We'll see what Apple has to say, but as they prepare to show us their AR, VR headsets coming up here, Apple's never been very big in gaming, but perhaps they could build a headset that allows us to have multiple screens visible just off your laptop. So you can sit in the coffee shop and have 2 or 3 screens in front of you. So there's probably some productivity things there. But ultimately, we view the metaverse opportunity as a niche area, primarily oriented around gaming. AI, on the other hand, we think is going to drive tremendous productivity gains and is a horizontal technology that is applicable really across every sector of the economy in a very profound way.
Great answer. There's a question about maybe somebody who's, I don't know, younger, I'm thinking, YT. Will tech be a good investment to hold for a long horizon till retirement? So, let's assume this person is younger and they have a long horizon of, let's say, 20, 30, 40 years. Is technology the right way to go? What is the right kind of allocation to that sector?
Ultimately, listen, we think that innovation and technology investing in particular should be a core part of everyone's strategy. The real question is, what is your tolerance for risk and what is your timeline to needing the capital back? And so if you are earlier in your investing career, you probably should have a higher allocation to innovation and technology. And if you are later in your investing career, you probably should have a smaller allocation. But the best thing to do is to have some exposure and to work with your financial advisor to make that decision.
Trusted advisor like Endowus, basically. Okay, one maybe last question since we're approaching the hour. Performance is something that always comes up, and we go through cycles. I've been an investor all my life, and I ran multi-billion portfolios for Asian emerging market growth equities, technology being a huge piece of it, TSMC, for example, being a big piece of it. Love that company. But as an asset allocator, it's very different, right? When you're an investor. And whenever I see a fund that is underperforming, I kind of get excited, especially if that fund has a long track record of good performance and you have a short period of underperformance, then I feel like, wow, this is something maybe we should look at. And so, let's own up to the fact that Franklin Templeton, technology fund has seen some period of underperformance. But if you look at the long track record, maybe we can, address this question for long. And, I'm excited at this point in the cycle to look at technology.
So the strategy has been around for more than 20 years. I've been associated with it for the past 15 years. Matt's been associated with it for the past 8 years that he's been with the firm. Over that plus 20-year history of the strategy, it's been a top quartile product. And many times it's been a top decile product. Our underperformance here of late started really in November of 21 as rates spiked very, very quickly. And that hurt duration assets, many of the growth type of technology businesses that we owned. And then some of the demand pull forward that came with COVID started to relax a bit as the world reopened. Importantly, though, we now believe we are near to the end of the rate cycle. So we're getting to a point where rates are going to be at least stable. That is going to be positive for duration assets and growth technology businesses. And secondarily, we believe that we are near the end of the estimate reduction cycle. That period post-COVID, post-reopening of technology companies realizing that those curves of growth would need to slow down and turn in the other direction are coming to an end. These companies have been right-sizing their business structures, but the secular growth opportunity around digital transformation broadly, and more specifically around artificial intelligence, which we've spent a lot of time on, but cloud computing and those other 8 pillars that we are focused on is no means done.
Yeah, absolutely.
This is a dollar opportunity with many, many years of growth ahead, many high quality businesses to invest in. And as Matt highlighted earlier, on a growth adjusted basis, quite reasonable valuations.
Yeah. No, great answer. And, for those investors who are, kind of geeky in the way they approach it, to maybe flesh out some of the things that John said, obviously the present value of any stock or company is the discount of future cash flows, and what discount you use, that's this interest rate, and the risk-free rate or the interest rate has been rising, which means that you need more you need to discount more of the future earnings.
Right.
And especially as a growth company or growth sector, you get heavily discounted. And that's kind of what's been happening in a rising rate environment. We've seen one of the reasons why the sector has rebounded 20% is precisely because interest rates actually peaked at the end of last year.
Yep.
People think that the Fed has been increasing and therefore interest rates have been rising, but the market moved way ahead of the Fed. And the Fed was behind the curve, and the market already peaked in October of last year in terms of market interest rates, and have actually been coming down. And during that time, technology has actually outperformed. So that's an interesting trend that we should be very aware of as we invest, because I think people think about macro and interest rates, but the Fed is not everything, and the Fed has been behind the curve, and market interest rates are actually a much more better indicator of that. I'm going to wrap up with one interesting philosophical, question about AI. Maybe if you have any strong views about it, is there a need, and possibly do you think there is regulation coming that may constrain the opportunity or the growth or the proliferation of AI?
Listen, I'm going to answer this in line with what I've heard the big tech companies say and what Sam Altman has had to say. In short, there is regulation coming. That is our base case assumption.
Because there's regulation on everything, from food to pharmaceuticals.
Certainly,
finance,
we think it is highly appropriate in this category. But even if the regulation said no more models can be built after GPT-4, right?
Which is unlikely to happen.
Which is very unlikely to happen. No more models can be built other than GPT-4. The innovation that can be extracted and the productivity gains that can be extracted out of a model like GPT-4 are profound. And we are seeing every technology company right now experimenting with that and learning how to build this into their business models. And we think a lot of value will be generated off of that. But we absolutely expect regulation to come. We think it's appropriate. There certainly are risks to society that need to be understood. And society needs to have a seat. Citizens need to have a seat at the table and ultimately make certain that the growth potential is offset with the values of humanity before this is deployed too broadly.
Yeah, fantastic answer. And with that, I'm going to really thank deeply John and Matt for joining us here in Singapore in the Endowus office. Thank you guys for coming all the way from Silicon Valley. Really enjoyed the conversation today. Loved having you and hosting you guys here. And thank you for the partnership. And we hope that you guys will kill it.
Congratulations on your success.
Thank you so much.
Thanks,
it's great to see you in person. And for everybody, thank you so much for joining us. We have many more series of webinars and interesting topics that are coming up. Please sign up on the YouTube channel or Facebook, LinkedIn, multiple social media channels that we're on, and we'll be updating you on any new interesting contents and webinars coming your way. So again, thank you so much, John, Matt. Thank you, everybody, for joining us tonight. Have a wonderful evening.